I'm Laura Richardson with Relevate. We are Real Estate Elevated, and we're bringing you a shorts edition of our episode, I'm Moving to North Carolina, Now What? So today we're going to talk about different types of loan products. Now keep in mind, I am a real estate agent. I am not a loan officer. So we're really getting into the facts of defining the different types of loan products. The purpose of this is so that you, the consumer, do know there's lots of different options, which is one reason why it's great to find someone you know, like, and trust in the mortgage industry so you can talk through what's the best opportunity for you and potentially your family moving here. So the first one is a conventional loan. Conventional loans can be a 15-year or a 30-year fixed. What that means is that the 15 or 30 is talking about the time that you're going to have that loan, and then fixed means a fixed rate. So you're going to have one interest rate over the course of that time. The big difference between the two is simply that the 15-year is going to have a higher monthly cost, but it is going to have a lower interest rate. So something to consider when you're looking at one versus the other. The predominant one is typically that 30 fixed rate. It's the most common one that people tend to use. Now, there are some other loan products besides the conventional, which tends to be the most commonly used. We also have something called a VA loan. Now, this is speaking directly to folks in the military sphere. This could be spouses or even children in some capacities, so make sure you know whether or not you are eligible. But a VA loan allows you to put as little as 0% down. Keep in mind, it's not guaranteed that you'll have 0% down, but that is an option. But the big thing with a VA loan is it's not going to require PMI. That's private mortgage insurance. Now, there is a funding fee associated with the VA loan, so keep that in mind when you're trying to calculate all those different costs. The other one is an FHA loan. So FHA and VA are both government-backed loans, meaning those funds are very secure because they are government funded. With that being said, FHA allows some opportunities if you have maybe a lower credit rating or, again, cannot put a lot down into a down payment. FHA will allow you to put as little as 3.5% of that down payment on the table, and it has a different type of funding fee associated with it. Another option, if you're looking in more rural, possibly some suburban areas, is a USDA loan. Now, the USDA loan is actually backed by the Department of Agriculture, and it does have some stipulations as far as what locations you can actually use it in. There's a handy online map where you can type in that address. Listing agents highly recommend you doing that as well before accepting a USDA loan. You want to make sure that you are applicable to use it on that particular property. But with the USDA loan, there's also some opportunities for as little as 0% down, and there's a guaranteed fee that's also associated with that one. There's another option that's kind of hanging out in the wings that a lot of people don't know about, and that's speaking to people in the medical industry with the physician's loan. So it's not just for MDs, it could also be PTs, DOs, and a lot of other folks that fall into that category. But the perk about a physician's loan, it is very similar to conventional. However, it can be as little as 0% down as well. You are still going to have PMI and some other things typically associated with a conventional loan, but it's a great perk for you to utilize if you fall into one of the applicable industries. And then the last one is called a CP loan, or a construction to permanent option. This one is typically seen when you are building a home, so from ground to the finish. A construction to perm loan, you actually close at the beginning of the project rather than at the end at that closing table when the home has been completed. So what's going to happen is you will close on that loan, and during the duration of the build, you will have interest-only payments. Those interest-only payments will work in conjunction with your builder doing withdrawals from the bank, from the lender throughout the build process in order to fund the project. So as you can see, there is a variation of products out there, so make sure to talk to your loan officer and choose the best one for you. I'm Laura Richardson with Relevate.
All right, y'all, thank you for joining us today. Be sure to like, share, and follow us on Instagram as well as YouTube. We're also on Apple Podcasts. Again, I'm Laura Richardson with Relevate.